Well, I have to admit this morning that I'm not totally objective because I was also attended the executive MBA program here at UALR, and I'm a graduate of their program. So take that in consideration as I make my talk this morning, that you're maybe a little bit biased. What I'd like to do this morning is just give more of what I call a less focused talk this morning about the economy and the Arkansas economy, and then blend in some comments about the setting on a national, on more of a national view. But on a daily basis, I do manage 3 economic development lending companies, and so I'm less statistical approached and more feet on the ground type approach. So we have, I'm going to say, roughly 350 companies in our portfolios that we have loans out to, the majority of which are all in the state of Arkansas. So I'm, getting a good feel on a daily basis of what's going on in the economy, albeit a subset of roughly 350 companies here in our state. So in my former life, I was a bank examiner, so I have a little bit of knowledge about the banking business. And what I'd like to do this morning, I do not have a PowerPoint presentation, so I'm just going to talk. Feel free to stop me at any point. I really would like it to be more of a flowing discussion, and stop me and ask questions. Really this morning, as I was preparing for this talk, I felt like we really need to talk about 3 things. And it's what I call the 3 C's of the economy. That's credit, consumers, and then confidence/attitude of Arkansans and Americans. Credit is where I want to start. And this is where I want to actually spend some time talking about the banking industry in the state of Arkansas. It's such a critical piece of the economy. Nothing, as we all know, nothing happens, or very little happens, unless capital flows. And access to capital, access to that capital flowing, of course, is very important. This is information, again, about Arkansas banks. So feel free, and I may make some comparisons to national, but just feel free to stop me, because some of this may be a little technical, and I'm going to skip some information I have, but I'm going to try to fill in what I think is the appropriate information. The good news is banks in Arkansas are healthier than on the national scale. Banks in Arkansas, for the most part, are conservatively managed. Sometimes maybe a little too conservatively, people might argue, but banks have been impacted by the recession. There's no doubt about it, and I'm going to give you some information that's going to help explain the impact that the economy recession has had on banks in the state. To my knowledge, we've had 2 banks in the state of Arkansas fail. The first one is being Arkansas National Bank in Rogers in northwest Arkansas. That bank failed in what I call the ordinary course of business. So we are fortunate that we've only had 2, in my opinion. The second bank is, the name of the bank is escaping me at the moment, but it's the bank in Batesville that got involved with that unfortunately made a substantial investment in the Kevin Lewis Improvement District bonds. And that bank, I believe First Southern Bank was the name of that. It failed, or it was taken over by there's regulatory agency, and was transitioned into new ownership because of the loss and the deterioration of capital and impact on capital from that loss. So really, in the ordinary course of business, we've only had 1 bank in the state fail, and I'm going to give you some statistics on the U.S. Let me just kind of jump into my comments on this subject. Level of troubled assets at banks does remain high in the state. That is the one area that no one would argue with. Compared to history, our level of troubled loans, primarily is what I'm talking about, does remain high. Excuse me? I would say it probably is, just because, Jerry, that's where the dollars are. But as far, if you looked at number of loans and said, let's ignore dollars and just look at the number of loans, I would say that wouldn't apply per se. I think it's but dollar-wise, it definitely does. But overall, I think it's more broad than that. Let's talk about the number of banks in the state. I was a state bank examiner from 1992 to 96. Back in the what I call the old days, there were, and specifically a year I'm going to use is 1993. There were 257 banks in Arkansas. 257. Anybody want to guess how many there are now in the state? Just all in. State and national charter banks. 257 in 93. You've been cheating. You've been looking at my notes. That's a very good guess. There are actually 122. So, but what that says is that, we have had a loss of 135 bank charters in the state over that timeline. And it happens so slowly, we don't realize over the course of this, I guess I'm talking about a 17 to 18 year period, but we've lost 135 bank charters. Good news is very few of those are bank failures. They're more from consolidation and just the ordinary course of business of banks buying each other and then, consolidation primarily. But that's a big change. I didn't calculate the math, but that is a big change. My earlier comments about bank failures. Bank failures are very expensive to the taxpayers. Bank failures, this is nationwide, after peaking in 2010 at 157 banks. That's 157 banks, and the cost to the taxpayers is $23 billion. So that is, it's a huge number. The cost is just tremendous. Year to date, the good news is 157 in 2010. Year to date 2011, we have had 73 failures. So we are definitely seeing a slight, really a moderate decrease in the number of bank failures in the United States. There's a push, as you probably have all read in the paper, by the regulators on increasing capital at banks. The numbers that if you could go on the internet, you could read about what is adequate capital in banks. In writing, you'll read one thing, but in reality and practice, you will find that regulators are requiring a much higher level of capital in banks these days, and it's more of a just on the fly type approach. It's not that we formally have adopted these new numbers. It really is the regulators are pushing substantially higher capital requirements. Something interesting is assets in Arkansas commercial banks is up substantially. We've seen a jump. It is up $56 billion, and that is from 1990 through June of 2011. And the good news is I do have current numbers, so through June. So the numbers I'm talking today, that I'm going to visit with you about, are good numbers. But we've seen a substantial rise in assets in banks in the state. Some of that is from the out-of-state acquisitions that some of our banks have made of failed banks in other states. Those deposits have been acquired by banks in Arkansas, but some of it is organic growth also. Interesting that I've seen, or a good point, we're talking about the state's economy today. Well, we have to, we'd be a little naive if we didn't realize that, different pockets of the state have different economies. Some very good, others not, others very, very poor. So largest deposit increase by county is something that we oftentimes look at, and this is from 2000 to 2010. I'm going to give you the 5 counties that have had the highest deposit growth from 2000 to 2010. And the number one is Pulaski County. They're up $4.7 billion in deposits. Second, surprising to me, is Benton County. I would have thought one of the northwest Arkansas counties would come in second, but Benton County was second at $2 billion, Washington County at $1.6 billion, Craighead County at $0.9 billion, and Faulkner County at $0.7 billion. So you see, the Northwest Arkansas growth has not necessarily outpaced. I was surprised that Benton County had that kind of growth. Benton County, yeah, and that to me that makes that number even more. Yeah, what were you going to say? Oh, that's Bentonville. Okay. That makes more sense. I'm thinking Saline County. Okay. Well, that totally, yeah, that makes a lot more sense. And so really, outside of Pulaski, the only other Central Arkansas county is Faulkner. So it's in fifth place at $0.7 billion. Craighead, that's Jonesboro. That was $0.9 billion. So it's in fourth place. Okay, moving on. Got a lot of information to give you guys. Out of state banks under regulatory order, this is any state chartered bank in Arkansas, and I don't have the number for total banks because it's harder to pull together. State banks under some type of regulatory enforcement action. Today, what we've seen is there was a delay of roughly 1 to 2 years before the recession. The impact of the recession was fully felt by Arkansas banks. So what happened in 2010 is where the number of banks under some type of enforcement action peaked at 23 banks. And that's out of 96 state chartered banks. So I'm just talking about state chartered banks, which is still a good barometer because they're spread all over the state. A state chartered bank is a bank that is chartered by the state bank department and not by one of the national national agencies. So 23 out of 96, that says there's 21% of banks under a regulatory enforcement order of some kind at the end of 2010. The good news is, as of June 2011, that number has dropped to 20. So 23 is 24%, and 20 is 21%. So we have seen a drop in the first 6 months of this year, which tells me that banks are working to mitigate some of their issues, and they have worked themselves back into a better position. The average over the last, I'm going to say, 10 years appears to be 8 to 10 banks. So you can see we're still over double the typical number of banks in the state that might be under some type of enforcement action. Dr. Packo mentioned return on assets. In the banking industry, return on assets is one of the best general barometers that's used to measure the successful performance of a bank. 1% is kind of the benchmark. A 1% return on assets is the benchmark. In Arkansas banks have done better than national banks. Let me just give you a few statistics. In 2009, at the trough of the recession, banks' return on assets were 0.58%. So literally almost one half of where the benchmark is. In 0.58 in 2009. In 2010, it improved to 0.77. So you see a pretty good improvement in 2010. And in 2011, I am just literally almost shocked that we've jumped back to 1.1% return on assets. Jerry, you asked, how could that happen? I knew you were going to ask that question, so I tried to have the answer. What you're seeing is the Fed has done has given the banks in the U.S., in my opinion, a very nice dose of low cost of deposits. As interest rates have been kept extremely low, Aunt Susie can't get 3% on her CD anymore. She's lucky if she's getting 0.75% on her CD. So, banks take our deposits, pay us interest on them, and then loan them out at a much higher interest rate to businesses and consumers. So there's a lower cost of deposits, cheap money I call it, improving loan performance, which increases earning assets and lower overhead. Banks, like every business, have become more efficient and lean in their operations. And then not to mention increased yield on loans. I recently saw some data that I believe will show that Arkansas banks have a net spread on their loan portfolio of right over 5%. So what you take is the loan yield of a bank, of their portfolio, minus their cost of funds, and that I'm showing that to be around 5%, which is up. That is up some. I can't tell you why, but it is somewhat. Loan quality. Loan quality began to decline in 2007, and it's now improving after charge-offs peaked at 1.17% for Arkansas and 2.6% for the U.S. And that peak occurred it occurred in 2010 year end. So they flushed a lot of the bad stuff through. Okay, we say, well, they flushed a lot of the bad stuff through. What about what's left? Well, let's talk about that. Let's talk about, this is probably the most important thing I'm going to say, in my opinion, today about banks. Non-current loans do remain high. Even though they have flushed a lot through the system and have liquidated and charged off a lot, Arkansas banks right now, their non-current loans are trending up. They're trending up. They were at 1.65% in 2008. So there's your scale, probably right on the edge of the recession, 1.65%, and in June of this year they're up to 4%. So you see and there's also been a jump of 0.5% since year end 10. So they're up from 08. They're probably double past due loans, double what they were in 08 year end versus 4.4% June this year, and they're up 0.5 point since year end 2010. So what does that tell you? To me, that does not paint a great picture. Now, how those loans turn out, that doesn't necessarily mean those are people or businesses that are going to ultimately end up with a loan being liquidated. That means that they're just seeing, for whatever reason, I think it falls in line with what we're seeing in the economy right now, especially what you're talking about in the last 3 or 4 months. Yeah. It can be any of the above, but typically when you're talking past due, you're talking about a loan that's at least 30 days past due, but less than, could be more than 90 days past due too, but typically in the range of over 30, but less than 90. That's the preponderance of what I'm talking, the majority of what I'm just talking about. A real important ratio that, have you ever heard of restructured debt? Restructured debt is any loan that is not paying according to the original terms of the agreement. A lot of times banks will try to work, lenders, not just banks, we're not a bank, we're a lender, but banks and other lenders will try to work with businesses and consumers in trying to keep the loan paying, but maybe paying at a lower payment amount, or maybe putting some payments on deferment, those type of things. So there's a ratio out there, and it's called, what it is, it's restructured debt plus past due loans plus other real estate owned. When a bank has to foreclose on property, they a lot of times take title to that property. They call that other real estate owned. If you take those three items and you compare it to a bank's capital, you get a ratio. And it's basically, I call it problem assets to total capital. It's really important to know, to me this is a tale of what banks are still dealing, or lenders are still dealing with. In 2006, that ratio in Arkansas was 7%. In June of this year, that ratio is 27%. That is a 286% increase if I did my math right. Okay, let's compare that to the nation. The nation is at 22%. So we're in Arkansas, our troubled assets that the banks are dealing with compared to their capital as a ratio, we are above the national average. Let's talk about loan growth for a minute. And I'm going to move fast through this because I've got some other comments, general comments I want to make after this, so I'm going to try to move on through this. Loan growth in 2007, loan growth at Arkansas banks was 8.5% in 2007. So if you want to say, well, that's probably a good barometer of where loan growth kind of maybe falls. In 2010, that number had dropped to 0.35%. In 2011, it is up slightly to 0.8%, but still 0.8 versus 8.5, big difference. So what does that tell us? One banker here in the state recently told me, he said, if it wasn't for loans that we are taking from other banks, then we would have no loan demand at all. And he's talking about business loan. That's talking about commercial credits. That's not talking about consumer necessarily. But still, the commercial portfolio is usually is for a lot of banks a bigger piece. But it's also more of a barometer, I think, based on how many businesses are borrowing money. Deposits. Let's talk about deposits. Deposits, there's been several $1 billion acquired from 16 failed banks. 16 failed banks have been acquired by Arkansas banks. What are banks doing with the cash if they're not loaning it out? If you think about loan demand, you go, well, why are they taking all these deposits if they aren't loaning it out? Well, they're taking all these deposits because a government-assisted purchase of a bank is a tremendous windfall for the acquiring bank. I mean, it's a complicated story to get into, but from a financial standpoint, it's a very good move most of the time for a bank if they can handle the markets where they're acquiring the banks. What are they doing with the deposits? They're shoring up their balance sheet. That's what they're doing. Cash is up by roughly 15%. Their cash holdings, their securities. Banks do one of two things primarily with their money. They either put it in loans or they put it in investments. And I'm oversimplifying it. They do more than that with it, but that's their two primary investments. They either put it in loans or they buy securities with it. U.S. Treasuries, government agency securities, those type of things. So their securities are up 20%, and their borrowings are down by 14%. Borrowings are where banks borrow from each other or borrow from the Federal Reserve or borrow through other means. So those are the money has not gone as much into loans as what maybe we hoped it would. Don't get me wrong. I mean, let me just say right now, banks are in the business to make loans, but the problem is banks are in what I call kind of hunker down mode. I mean, they're being very careful. Underwriting standards have tightened. The businesses that are coming to banks to borrow money are not as strong maybe as they once were. So you have this perfect storm that even though banks do want to make loans, it's harder for them a lot of times to get to the goal line of doing that. So, yeah. That's a very. That's right. That's right. Banks are, what he's talking about is really there's what I call, when you put capital out, you really put it out in two types of forms. You're putting it out either in debt, which is secured by hard assets or by tangible assets, or you're putting it out in the form of either equity, or you're either putting it out either in equity, and equity may be where you're actually taking stock and ownership in a company, but you can also just put it out. It can be treated like equity, but it's unsecured debt, where it's a startup company that needs capital or an early stage company, and that's what Jerry's talking about. It's a very, very tough phase for a company that's needing capital to grow and maybe either grow their existing product or services or trying to take their product to the marketplace. So that's a very challenging area, and there is a definite lack of it in our state. And yeah, and there is some positive things are happening with that, and hopefully some of the stimulus money that we're getting, our state's getting. My understanding is it's not been received. I think that's going to open some more doors with that if you're keeping up with that, Jerry. Okay. Yeah.
About a year ago, when I was talking to some business people, I came up with this kind of anecdotal picture of what's going on, and maybe I could ask you if you still think this is relevant.
Okay.
Businesses were saying, well, we're finding it really hard to access capital and bank loans in particular. Mm-hmm. I talked to bank loans or bankers, and they'd say, well, we'd love to be lending, but we just don't see the credit-worthy borrowers out there. And asked, well, have you tightened your credit standards? And the response was, yeah, but that's because the regulators are forcing us to. So it's kind of passing the buck. Is that still kind of the way people would characterize the situation?
I would say that at some point, the regulatory pressure on banks to improve asset quality, there are two things: improve asset quality and increase your capital. That was kind of probably the two big hammers. And so at some point, the regulatory pressure on banks did peak. And I think at that point, they were legitimately saying, we want to make loans, but the regulators are, the politicians are saying, make small business loans, make small business loans. But off camera, the regulators were saying, you've got asset quality problems, you need more capital, and you can't have it both ways. So I think, to answer your question, some of that pressure has eased from the regulatory perspective. And I think banks have cleaned up their balance sheets. And I really see an environment where if an acceptable credit risk, business credit risk, walks in the bank, that if they are an acceptable credit risk that have some collateral and cash flow and good management, they can get a loan. I totally believe that. If they can't, I think there's a problem with the credit of some type. Because let's face it, in this recession, we have a lot of banks that want to make loans. There's still as many banks trying to put the capital into play, but there's not as many good credits today. So I think there's more competitive pressure among the banks, which ultimately help the small businesses at the end of the day. Let's talk about lump mortgages just a minute. Dr. Packo hit on this, so I don't want to beat this horse to death. But I will say that, let me just go further back than he did. Mortgage loans and process of foreclosure, actually my numbers say it has spiked compared to historical levels. It spiked in Arkansas and in the U.S. And this is loans in the process of foreclosure. In I have 84 numbers, but I don't want to go that far back. Let's just go back 20 years to 1999. In 99, Arkansas loans in foreclosure was 1%. The U.S. was 1.18%. So fairly close in 1999. June 2011, the numbers are Arkansas 2.25% versus the nation at 4.4%. So you see, it's doubled in Arkansas and it's over tripled nationally, and that would make sense with what Dr. Packo is saying. But anyway, I think foreclosures are still a big problem. I think it's a major drag on the housing industry. Housing, the one thing I don't think that Dr. Packo got into is the effect of negative equity. Does everybody understand negative equity? I don't want to get too elementary with you, but if you don't know what that means, it literally is the value of your house, the fair market value of your house is less than the mortgage, less than your loan that you owe on the house. Yeah, you're underwater, right. You hear that term usually with the car loan, but this day and time, there's a lot of homeowners that are facing that situation. Across the U.S., Nevada is number one with 60% of homes with negative equity. Next is Arizona, then Florida, then Michigan, then California, and then Georgia. Those are the top 6, and then it drops from there. Arkansas is 10%. So that means we have 1 in 10 homes in the state of Arkansas with negative equity. And that is as of June 30th. So these are fresh numbers. And what's happening is the degree of negative equity, in my opinion, is hampering the housing recovery by reducing sales that take place and also reducing a consumer's ability to refinance their home. I mean, you know, you could be trapped. I mean, you may have a 6% home mortgage and you could go down to 3.5%, but you can't get it done because you don't have enough money to bring to closing. Yeah, Clay?
Isolate 1 in 10 primarily in Northwest Arkansas?
I would not want to say that, no. But it's probably a bigger piece of it, but I wouldn't want to try to guess. I don't have that information, so I wouldn't know what to guess on that. Anyway, let's how much more time do I have, Tanya?
You've got plenty.
15 minutes maybe?
Sure.
Okay. That's on banking, so I wanted to kind of give you that piece because that's really, I think, important because typically in banks, as much as we want to talk about other sources of finance, banks are the primary provider of capital to small businesses. Now, when you get in early stage companies or high tech and things like that, Jerry's talking about risk-based match capital and sometimes other sources that are not traditional bank type credits. So we talked about credit, what's going on with banks and credit availability. I've just got some general comments I want to make about consumers. What is the mode and climate of consumers in Main Street of Arkansas, and then also, confidence, attitude, and just general psyche of Arkansans and Americans. On consumers, like Dr. Packo, I think we can all agree the current recession downturn is the longest and deepest contraction in our economy since the Great Depression in the 1930s. You know, when you're living in it, I don't really think you really realize the true impact it's having. But I will tell you this, trying to give you guys some real life examples of what our company is experiencing and has experienced. This is it's a sad statistic to say, but I've been with the company, Arkansas Capital, for roughly 16 years. And this is just I'm making a general guess, so don't hold me to this or don't quote me on this. But I would say that we've had more of our businesses that we have loaned money to go out of business in the last 2 years than we've had in the prior 16 years I've been with the company. Motel, hotel loans never were a problem. Now they're dropping like flies. And, you know, it's about just the recession, that people are not traveling as much. Businesses are not sending their people out for as much overnight travel. Technology, as we all know, is driving change. You're seeing more and more utilization of technology where used to you didn't have a choice. If you wanted to go to a conference or hear somebody speak, you came in person. Today, webinars and the use of technology are driving major changes. I think we'd be remiss if we didn't say that and point out that consumers are facing the stark reality of past years of living beyond our means. The hot economy that we've had for however long. How long, Dr. Packo, did we have? Would you say we had the huge expansion, or was it?
Well, we had a very slow jobless recovery from 2001 that persisted about 2004. So, 4, 5, 6, 7.
So we had 4 or 5 years of where the economy really got pretty strong. Well, that hot economy, in my opinion, was financed with growth in credit card debt, strong home equities, which translated into attractive home equity loans. That became a huge industry. These two factors provided the needed fuel to propel consumer spending and boost bank profits. It was just a cycle that once it got going, it was rolling. Today, we're seeing the fallout of the past with lower credit availability, little or negative equity in homes, And then I also think we've got to acknowledge, I think there's been a general paradigm shift in the way consumers think. Used to, we went out and wanted to buy the 3,000 square foot house, and all of a sudden the person that used to like that house now goes, a 1,500 square foot energy efficient house, that's really green. That seems to be the in vogue thing that a lot of people are talking about. So all that, by changing the behavior, it's led to reduced economic activity as consumers shift to paying down debt and lowering their overall household budgets. We must all remember that consumers account for 73% of GDP. That may be a little high, but it's somewhere in that ballpark. It would be it would seem that a meaningful percentage of lenders and consumers, as I said earlier, are in hunker down mode. I mentioned that about bankers, but consumers, I think there's people that could go buy a new car tomorrow, but are they going and buying new cars? Well, in Arkansas, the car sales are actually up, but I think there's still a lot of people that go, well, this 10-year-old car that has 150,000 miles on it still drives fine. I think that the elevated unemployment rate has also caused a drag on the economy. More unemployed folks that exist, and for every day that goes on that they remain unemployed, results in lost economic activity because the discretionary dollars are not available to spend. They may have government unemployment and things like that, but there's still a gap. They don't have the same dollars that they did at one point. We believe there's a general reluctance by consumers and businesses to borrow at this time. Why? I believe it's tied to fear, a general perception of fear fed by a feeling of uncertainty in the marketplace and concerning national politics and the poor fiscal health of our country. To me, there is nothing worse than uncertainty. We can all handle whatever is in the future holds, but we just want to know. Not knowing what the economic future of our country holds, and I think it has an overall negative drag on people, for whatever reason. I understand. Consumers, here's another important point. This has to do with real income, personal income, and inflation. Consumers that are employed are beginning to note that their household incomes are not keeping up with the pace of inflation. Now, I'm talking in general terms. There's exceptions to all of this. But without real growth in personal income, we likely won't see meaningful economic growth in the U.S. or Arkansas for that matter. I really can't reiterate enough that income growth has got to occur and credit must flow freely. If this happens, consumers will be much more willing to spend. But if inflation, whether calculated or real inflation, is exceeding growth in personal income, there's a feeling of less wealth. There's a feeling of less disposable income, and I really think we're seeing some of that now. It's real in vogue, I think, for businesses to go, because of the economy, because of this and that, we can't give our employees a raise this year. So if you don't get a cost of living raise, there are people out there that would say your purchasing power is going backwards because inflation is there, pretty much. I guess we could have deflation, but I don't think we're having deflation. All right, just a couple more points, and then I'm going to wrap it up. Confidence. You hear a lot of talk about the Fed's efforts to lower interest rates. For some reason, this has received a lot of attention, and I guess it's because it's one of the main tools in the Fed's toolbox. That the low interest rates. If we can just get interest rates low, that'll encourage everybody to go out and spend their money. I would suggest that in this economy, great rates, even as low as 1%, is not necessarily going to be enough motivation to get consumers to spend their money on goods and services. Rate alone will not do it. I could tell Jerry, I'm going to give you 0% financing if you'll go buy a $40,000 car tomorrow. If he's not in the mood to spend $40,000, even if it's 0% for 60 months, that may not make him go do that. So my attitude is it takes a strong dose of confidence. And unfortunately, I'm not optimistic that our economy in our federal government in the short term is going to change this reality that we do have somewhat of a lack in consumer confidence out there. I have not seen the official numbers. You may have them, but I'm just basing that on without seeing official numbers. Jerry, to talk to something that's near and dear to your heart, I think we've got to figure out how to bring production and manufacturing jobs back to the United States. You know, I have a job. I'm blessed in a way because I've been with my company for 16 years, but I have a job where I sit at a desk every day, I push paper, I exchange information with people, and not everybody can have that type of job. Not everybody skill set fits that type of job. There are people that want to make something with their hands. And I think we've lost way too many manufacturing jobs, and it's hurt our economy beyond what I think we can really calculate. If we have job growth, we will have increased consumer income, which will ease credit providers and give consumers a newfound willingness to spend. If consumers are spending, what happens then? Businesses turn around and place orders for raw materials and new goods to restock their inventories, and the whole cycle begins to have a healthier glow and attitude to it. You know, I really don't want to get into politics, but I do have to make a few comments because that's whether we like it or not, it's part of the cycle. Unfortunately, I'm not sure politics is going to allow this to happen in the near term. I would suggest that the manner in which our debt ceiling debate went down, I really feel like that was maybe a turning point in the economy trying to regain traction. But when we saw the politicians just fighting to 11:59 before the decision had to be made, I think that was a very negative impact on the psyche of the American people. You know, I mean, you just go, it didn't have to go down that way, but it did. And it tells me that maybe our politicians, you know, get caught up in the fighting and are more concerned about that, you know, than what the impact it has. So I think that was hurtful. Not to mention that shortly after the episode played out on the debt ceiling debate, what happened after that? What was the next major federal that happened to our federal government? We lost something. We lost our AAA credit rating. See, Jerry? And so, you know, you had two big whammies right back to back. You know, the debt ceiling debate and the loss of our AAA credit rating. What more do I need to say about the environment that won't allow confidence to build like it needs to? Plus, I predict that we're going to see some pretty negative political scenery between the parties between now and the presidential election in November of next year. So we're 13 months away from that. I just read this on CNN last night, and I think it's kind of a good summary of on the internet, a good summary of where our political parties are. President Obama's $447 billion jobs plan appears to have stalled in the Senate, and this is the key words, reflecting a cavernous ideological divide over economic growth strategies between the parties. I think that's what we have. We have a cavernous ideological divide between the parties over economic growth strategies. Does anybody disagree with that? If you do, tell me why. So, all right, closing, a couple of comments. I'm running a little bit over, but I've got just a few comments to wrap up with. I don't think Dr. Packo mentioned, did you mention inflation in your?
No, I didn't.
Okay, well, I'm beginning to become more concerned about the level of inflationary pressure that I think is building. We have a problem, in my opinion, with the price of commodities, oil, thus gas, corn, precious metals. Let me count the ways. It's leading to higher levels of real inflation. If my numbers are right, I believe, Dr. Packo, I'm seeing current government inflation is around 3.8% is annual projected, the inflation rate that the government uses. I tend to believe that we're looking at what I call real inflation, which is the impact it has, all prices have on the consumer. I think it could be as high as 10% or higher. So you can debate me, or we can talk about that one if you disagree. But to me, we are seeing the price of gas, corn, what it's doing, the cost of corn, and what it's doing to the prices we pay for things at the grocery store. I had a gentleman tell me yesterday, we can talk about inflation, but I also want to mention in Arkansas, because we're such an ag-based state, the extremities of our weather and the impact that we're seeing on that. The drought that Arkansas is facing has been severe, and I think it'll increase its negative impact on the state if meaningful rain is not received in short order. Why would I say that? I won't name the name of the company because I don't get into talking about individual companies, but there is a company in South Arkansas that I'm being told that might have to shut down their production if water needed for their manufacturing production gets any more critically low. That they use a lot of water in the production of their product, and their sources of that water are getting to a point where I guess state regulators and this and that say, the water levels can't go any lower. Also, talking about hay, just to give you a good example on talking about the impact of the drought on the cattle business. I was told last night that round hay bales normally sell in South Arkansas for $25 a bale. And that what's happening now is people are coming from Texas to our state buying those hay bales for $75, so buying something for 3 times what it normally sells for, transporting it to different parts of Texas and selling that $25 bale of hay for $140. What do you think that's going to do to beef prices? I also was told by this person I talked to that he thinks there could very well be some shortage of beef in the not too distant future if this keeps on. But to end on a positive note, it's like anything in the economy. You can always find positive things. I hear, we're financing companies on a monthly basis, some being a startup. We just financed a new yogurt company in Conway. They're opening in Conway, a startup yogurt store. Car sales are up from what I'm reading. That, to me, that's encouraging because that is a discretionary, large ticket purchase. And I read an article, Dr. Packo, did you see the article on Arkansas's budgeting process? And it's in the Arkansas Reporter. Is that what they call it?
No, I didn't see that.
Yeah, it just came out. I saw it about a week ago. And the news is Arkansas's state budget is in great shape, as you know. We are oftentimes distinguished as having one of the best budgeting and fiscal management out of all states in the U.S. Somebody told me that California actually commissioned some budget expert that actually came to Arkansas, and California paid him to study our model. So I thought that was pretty neat. But I'm not sure why our federal government couldn't take a lesson or two from Arkansas. It's really pretty simple. We don't and can't spend the money that we don't have, and that is a state law in Arkansas. Our state government cannot spend more money than it brings in. Kind of to end it, there are always winners and losers in any economy, and I do know a number of businesses in our state that are doing very well, that are hiring people, that are growing, and to me, the winners of a winning aspect for small businesses are there's a lot of refinance opportunities because banks are not having as much opportunity to make organic loans to businesses they're wanting to expand or start up. So what they're doing is they've still got to do deals just like any business, so they are refinancing existing business debt. And when you refinance, what do you got to do to get somebody to move their business to you? You got to offer them a better deal. And so we're hearing stories of businesses that maybe had loans in the 6 or 7% range, getting refinancing on their debt at maybe in the 3.5% to 4.5% range. So that in and of itself provides more working capital, internal working capital to businesses, as they don't have to pay out as much of their cash for loan payments. that's pretty much the end of my talk. Any questions or comments or anything I said you agree with or disagree with?
I know I work with a lot of existing industries, and I think the big thing you hit on is the consumers of content. And I know for us, we approach those same three C's, but maybe in a different, we actually look at trying to build confidence first.
Mm-hmm.
Then try to help with the consumer demand, and then back it up with the credit. So maybe it's just a process that we try to follow, because I think we can business grow with it. These are some of the three factors that we see ourselves.
Yeah, I totally agree. I mean, it's kind of like a stool. A stool is only good if it has all its legs, and if you weaken one of its legs, and it's not going to do what you want it to do. So, all right.